You think banks lend money that already exists? You're wrong. Right now, at this exact moment, commercial banks across America are creating billions of dollars that never existed before. Not printing it, not moving it, creating it from nothing, with a keystroke. And the system is designed so you never question it. Here's what they don't tell you. When you walk into Chase or Bank of America asking for a $50,000 loan, they don't check their vault. They don't transfer money from someone else's account. They open their computer system and type $50,000 into your account. That's it. New money. Created instantly. And this isn't some conspiracy theory buried in dark corners of the internet. This is documented, verified, admitted by the Bank of England, the Federal Reserve, and every major financial institution. Yet somehow, most people live their entire lives believing money is scarce. The question isn't whether banks create money. They do. The real question is why this truth remains hidden in plain sight. Why does the average person still think banks are just middlemen moving existing money around? Who benefits from this illusion? And what happens when you understand the game being played? We're about to examine the machinery behind modern money. Not the fairy tale version you learned in school. The real version. The one where 92% of all money in circulation was created by commercial banks through lending. The one where the very foundation of our economy runs on a secret most people will never discover. Let's start with what you were taught. Economics textbooks still push the financial intermediation story. Banks collect deposits from savers, they say, then lend those deposits to borrowers. Simple, neat, comforting. There's just one problem. It's completely false. The Bank of England destroyed this myth in their 2014 research paper. They stated clearly that this common narrative is wrong. Banks don't lend out deposits. They create deposits when they lend. Think about what that means. When a bank approves your mortgage, your car loan, your business credit line, they're not taking money from someone else's account and giving it to you. They're generating new money. The moment they hit enter on their computer, money that didn't exist 1 second ago now exists. It appears in your checking account as a deposit. You can spend it. The car dealer accepts it. The previous homeowner accepts it. Everyone treats it like real money because it is real money. Commercial bank money. And here's the thing that should terrify you. This process has nothing to do with how much actual currency exists in the economy. Let me paint you a clearer picture. John deposits $100 in his bank account. He still has full access to that $100. He can withdraw it any time. Now the bank looks at John's deposit and sees an opportunity. They lend $50 to Mike. They create a new deposit of $50 in Mike's account. Here's where it gets interesting. John still has his $100 claim. Mike now has a $50 claim. The bank holds $100 in actual reserves, but the banking system just recorded $150 in deposits. $50 was created from thin air. This is fractional reserve banking at its core. And when you scale this across thousands of banks making millions of loans every day, you begin to understand how the money supply explodes far beyond the base currency the Federal Reserve ever printed. The numbers are staggering. Between 2011 and 2020, American banks created an average of $10.7 trillion annually through this lending process. That's 57% of the entire GDP. Every year, created by commercial banks. Not the Federal Reserve, not the Treasury Department. Private corporations generating more than half the economy's value in new money through their loan operations. And almost nobody knows this is happening. Now you might be thinking, if banks can just create money whenever they want, why don't they create infinite amounts? What's stopping them from lending recklessly and collapsing the system? Great questions. There are constraints. But understanding these constraints reveals an even deeper manipulation of the system. First constraint, capital requirements. Banks must maintain a certain ratio of actual assets to their lending. If they create too many loans without sufficient backing, regulators can shut them down. Second constraint, reserve requirements. Except here's a secret within the secret. The United States, the United Kingdom, Canada, Australia, and New Zealand don't actually enforce reserve requirements anymore. The Federal Reserve eliminated reserve requirements completely in March 2020. Let that sink in. The main control that was supposed to limit money creation no longer exists in the world's largest economy. So what really limits bank lending now? Demand, profitability, risk assessment. Banks create as much money as they can profitably lend to credit-worthy borrowers. When the economy booms, lending expands, money creation accelerates. When recession hits, lending contracts, money creation slows, the money supply can actually shrink. This isn't the government controlling money. This is private banks controlling money based on their profit calculations. And this leads us to a crucial realization that economists avoided talking about for decades. Remember the money multiplier theory? The one where the Fed injects reserves into banks and banks multiply it through lending based on the reserve ratio? 10% reserves means 10 times multiplier? That theory dominated textbooks for generations. It's still taught in many college courses today. And it's fundamentally backwards. Research from the Federal Reserve Bank of Philadelphia in 2023 proved what many economists suspected. Banks don't wait for deposits or reserves to make loans. They make loans first. Then they figure out how to get the reserves they need afterwards. The central bank accommodates the bank's lending decisions, not the other way around. This reveals the most uncomfortable truth about our monetary system. Commercial banks have more control over the money supply than the Federal Reserve itself. When banks decide to lend aggressively, money floods the economy regardless of what the Fed wants. When banks decide to pull back, money vanishes regardless of how much the Fed tries to stimulate. The 2008 financial crisis proved this. The Fed pumped trillions into bank reserves trying to jumpstart lending. Banks sat on those reserves. Lending stayed frozen. The money multiplier collapsed. All that quantitative easing barely moved the needle on actual money creation because banks refused to lend. The emperor had no clothes. Let's examine what this means for you personally. Every dollar in your checking account is really just a bank's promise to pay you. It's not backed by gold. It's not backed by government cash in the vault. It's backed by the bank's loan portfolio. Your deposit is a liability on the bank's balance sheet. The bank's asset is the loans they made. Your money is literally someone else's debt. When people repay their mortgages, money gets destroyed. When businesses pay off credit lines, money disappears from existence. The money supply is constantly being created and destroyed through the lending and repayment cycle. Now consider what happens during a financial crisis. If everyone suddenly wants to withdraw their deposits at once, the bank doesn't have the money. They lent it out. Except they didn't really lend it out because it never existed until they created it through lending. This is why bank runs can destroy banks overnight. The entire system is based on trust that most people won't demand their money simultaneously. It's a confidence game, and when confidence breaks, the illusion shatters. The Federal Reserve exists primarily to maintain this confidence. They're the lender of last resort. When banks face liquidity problems, the Fed provides reserves so banks can meet withdrawal demands. They're not controlling the money supply in the way most people imagine. They're acting as the insurance policy that keeps the private money creation system running. Think about what happened in March 2023 when Silicon Valley Bank collapsed. The Fed immediately created the Bank Term Funding Program to pump liquidity into the banking system, not to control inflation, not to manage employment, to prevent panic withdrawals from destroying other banks. This brings us to the big question: why is this system designed this way? Why do we let private banks create money instead of having the government create all money? The historical answer is fascinating and disturbing. Private banking families understood centuries ago that whoever controls money creation controls economic power. The goldsmiths in medieval Europe figured it out first. People deposited gold for safekeeping and received receipts. Goldsmiths realized they could issue more receipts than they had gold because not everyone would claim their gold at once. They started lending these extra receipts at interest, money created from nothing, profit from thin air. Fast forward to 1913, the Federal Reserve Act established a system where private banks could create money, but with a government-backed central bank to bail them out when things went wrong. The banks got the profit from money creation. The taxpayers got the risk. It's privatized gains and socialized losses embedded into the core architecture of American finance. Abraham Lincoln saw this coming. When he issued United States notes during the Civil War, he wrote that the government should create money for public benefit, not private enrichment. Those notes were debt-free money created by the government. The banking establishment hated it. After Lincoln's assassination, those notes were phased out. Private bank money creation resumed its dominance. Today's system creates an inherent wealth transfer mechanism that few people recognize. Banks create money when they lend. They charge interest on that money. But the interest was never created. If banks create $1,000 in new money through lending, they expect $1,100 back with interest. Where does that extra $100 come from? It has to come from somewhere else in the economy. Someone else has to go into debt. The system requires perpetual debt growth just to service existing debt. This isn't a bug. It's a feature. It ensures banks have a continuous stream of borrowers because the math of the system demands it. The implications extend into every corner of modern life. Housing prices? Driven by bank lending. When banks loosen lending standards and create more mortgage money, housing prices soar. When they tighten lending, prices crash. Not because houses themselves change value, because the money available to buy houses changed. Stock market bubbles? Same mechanism. When banks create abundant credit, money flows into assets, prices inflate. When credit contracts, asset prices collapse. The boom-bust cycle isn't random. It's inherent to a system where private institutions control money creation based on profit motives. Consider the inequality dimension. Who gets access to newly created money first? The wealthy, the connected, the corporations with existing relationships with major banks. They get loans at favorable rates. They invest that new money into assets before prices rise. By the time that money filters down to average workers through wages, prices have already increased. This is called the Cantillon effect, named after an 18th century economist who observed that whoever receives new money first benefits most. The money creation system itself generates inequality by design, and here's something that should make you angry. During the 2008 crisis, when the banking system nearly collapsed due to reckless lending, what happened? Taxpayers bailed out the banks. The Federal Reserve created trillions in reserves. Banks that destroyed the economy through predatory lending got saved. Homeowners who lost their houses got foreclosed. The institutions that created worthless money through fraudulent loans suffered no real consequences. Many paid small fines that were a fraction of their profits. Executives kept their bonuses. The system protected itself. The same thing happened in 2020. When COVID hit, the Fed's balance sheet exploded from $4 trillion to $9 trillion in months. They bought government bonds and mortgage-backed securities from banks, pumping reserves into the system. Banks used those reserves to create even more money through lending. Where did that money go? Asset prices exploded. Stocks hit records. Real estate went insane. Wealth inequality reached levels not seen since the Gilded Age. Meanwhile, millions of Americans struggled with unemployment and inflation. The money creation system enriched those who owned assets while devastating those who didn't. Let me show you how deep this goes. The Bank for International Settlements, often called the Central Bank of Central Banks, stated explicitly in their research that money creation is primarily done by commercial banks, not central banks. This is true throughout the developed world. Every major economy operates this way. It's not uniquely American. It's the global financial architecture, and it's deliberately opaque. Financial education courses don't teach this. Media doesn't discuss it. Politicians avoid it. Why? Because understanding how money really works is dangerous to the existing power structure. When people realize that money isn't scarce, that it's created on demand by banks through lending, they start asking uncomfortable questions. Why do we have homeless people when banks can create money to build housing? Why do we have crumbling infrastructure when money can be created to fix it? Why do we have medical debt when money can be created for healthcare? The answer is, those things aren't profitable for banks. Money gets created for profitable ventures. A mortgage on an expensive house is profitable. Student loans with high interest are profitable. Corporate buybacks are profitable. Public goods that don't generate returns? Banks won't create money for that. And since banks control money creation, those things don't happen unless the government steps in. But even government spending is constrained by the illusion of scarcity. Politicians claim we can't afford universal health care, free college, infrastructure investment. They point to the national debt as proof we're out of money. Yet the same politicians approve trillions in bailouts for banks with barely a debate. Why? Because they understand, consciously or unconsciously, that money is never the constraint for politically important constituencies. Money can always be created. The question is, who benefits from that creation? And currently, the answer is those who are already wealthy. The modern monetary system is perhaps the greatest sleight of hand in human history. It hides in plain sight. The mechanics are documented in academic papers and central bank publications. Yet the average person has no idea that 92% of money in their economy was created by commercial banks, not governments. They don't know that every dollar in circulation is someone's debt. They don't understand that interest payments drain wealth from the productive economy into financial sector profits. This ignorance isn't accidental. It's essential for the system to function. Because here's what happens when people understand money creation. They question everything. Why should private corporations have the power to create money? Why should taxpayers bail out banks when they make bad bets? Why should we accept boom-bust cycles as natural when they're created by the lending decisions of profit-seeking institutions? Why should we tolerate inequality that's baked into the money creation process itself? These questions threaten the foundation of modern finance. And those who benefit from the current system have every incentive to keep these questions from being asked. Austrian school economists like Murray Rothbard called fractional reserve banking a form of fraud. They argued that creating loans without having the deposits to back them is essentially counterfeiting. It's creating money that doesn't represent any real savings or production. It's just ledger entries, digital promises. And when too many people try to redeem those promises simultaneously, the fraud is exposed. Bank runs happen. Financial crises erupt. The system reveals its fundamental instability. Defenders of the system argue that money creation is necessary for economic growth. Without banks creating credit, they claim, there wouldn't be enough money to finance business expansion, home purchases, education. And there's some truth to this. In a growing economy, the money supply needs to grow too. But the question is, who should control that growth? Should it be private banks motivated by profit? Or should it be democratic institutions accountable to voters? Should money be created for public benefit or private gain? Some economists propose alternatives. Public banking, where state-owned banks create money for public infrastructure and services. Full reserve banking, where banks must have 100% reserves for all deposits, eliminating fractional reserve money creation. Central bank digital currencies, where the Federal Reserve issues digital dollars directly to citizens, bypassing commercial banks entirely. Each alternative threatens the current system's power structure, and each faces massive resistance from the banking industry. The reality is that money is power. Whoever creates money wields enormous influence over the economy. Under the current system, that power rests with commercial banks. They decide who gets loans. They decide which industries get funded. They decide when to expand credit and when to contract it. These decisions shape everything from employment levels to housing affordability to the viability of small businesses. And these decisions are made by private corporations accountable to shareholders, not citizens. You're living in an economy where the most fundamental resource, money itself, is created by institutions whose primary obligation is profit maximization, not full employment. Not price stability, not equitable wealth distribution. Profit, and the way they maximize profit is by creating money through lending at interest. The more money they create, the more interest they collect. The more interest they collect, the more wealth transfers from borrowers to lenders. This is the engine that drives the system. And it's hidden behind layers of complexity and technical jargon that make most people's eyes glaze over when the topic comes up. But you can't glaze over anymore. You now know the secret. Banks create money from nothing when they lend. That money is your deposits. Those deposits are backed by debt. That debt generates interest payments that flow to bank profits. Those profits concentrate wealth. That concentration of wealth creates political power. That political power ensures the system perpetuates itself. This is the cycle. This is the machine. And it runs on the ignorance of the population it's designed to exploit. So what do you do with this knowledge? First, understand that your relationship with money has been built on a myth. Money isn't what you thought it was. It's not a scarce resource that must be carefully managed. It's an accounting entry that can be created at will by institutions with the legal authority to do so. Second, recognize that debt in this system isn't just personal failing or poor financial management. It's a structural necessity. The system requires perpetual debt growth. You're not weak for having debt. You're caught in a system designed to create it. Third, question everything you've been told about economics. When politicians say we can't afford something, ask why banks can create trillions for bailouts but not for public goods. When economists talk about sound money and balanced budgets, ask why those rules never apply to bank rescues. When financial experts warn about moral hazard and market discipline, ask why banks face no real consequences for reckless lending that destroys the economy. And finally, talk about this. Share this information. The system's power comes from secrecy and complexity. When people understand how money really works, they can't be manipulated by false scarcity narratives. They can't be told that there's no money for healthcare while banks create trillions for stock buybacks. They can't be convinced that austerity is necessary while the wealthy accumulate unprecedented fortunes through access to newly created credit. The secret of money isn't complicated once you strip away the jargon. Banks create money when they lend. That's it. That simple fact undermines nearly everything you've been taught about economics, finance, and the nature of money itself. And that's exactly why it's been kept secret for so long. Because once you understand it, you can never look at the financial system the same way again. The question now is, what are you going to do with this knowledge? Are you going to continue participating in a system designed to extract wealth from you? Or are you going to demand something different? Because understanding how money is created is only the first step. The next step is changing who creates it, who benefits from it, and what purposes it serves. That's the conversation we need to have. That's the debate that terrifies the banking industry, and that's exactly why we need to have it. So here's my challenge to you. How would you design a money system if you were starting from scratch? Would you give private banks the power to create money? Would you allow them to charge interest on money they created from nothing? Would you structure it so wealth concentrates at the top while debt burdens those at the bottom? Or would you do something radically different? Drop your answer in the comments, because this isn't just an academic question. It's the foundation of how we organize society. And it's time we stopped accepting the current answer as the only possible one.